Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Hello and welcome back to Cash Talk, and today I'm joined by a very special guest, Brian Parker. Brian, how are you?
I'm really well. Good to be here.
Good to have you here. Now, I've been following Brian for many years. Remember him back in his MLC kind of Economist days, but now he's call you Chief Economist at ART?
Correct, Chief Economist of ART.
There you go. And ART, for people that don't know, because we use acronyms all the time, is Australian Retirement Trust. It's one of the biggest superannuation funds in Australia, and we want to really hear from Brian around, his take on some certain things that are happening both at a macro level, global level, and both at a micro level as well too in regards to what's happening in the economy. Money is affected by economies. It's affected, both in the household and around you. And so this is a discussion that I've been looking forward to for a few months now, to be honest with you. We've been planning it in the background, but obviously diaries have fallen in today. But more importantly, you're a Sydney man.
Correct. Lived in Sydney for most of the past 30-odd years.
And question is around sport.
Okay.
Are you AFL, NRL, mixture of both, and then who do you go for?
Mixture of both. Put it this way, I'd like to think I'm a Queenslander 3 days of the year. So that's pretty much where I sit. So
Okay.
It's funny, there's something happens to a Queenslander.
Yeah.
I might just sit there and watch the game just to hang out with some mates. Mm-hmm. And then in first state of origin, I just become this kind of monster.
Oh wow!
Yeah, it's quite. So
scary. You're a maroon.
It's sort of like the rugby league equivalent of going for Collingwood, right? You watch the game, and a normal human being becomes a fanatic.
Okay.
And state of origin still does that to me.
For you, and so AFL, who do you support? Lions?
Probably not. Also Swans.
Swans
to be honest.
there. Okay.
But even then, I'll kind of watch what's going. I just think that, league, union, football, AFL, they've all got their strengths, right? Mm-hmm. I think AFL is a game that I'd much rather see live than on TV. Don't think TV does AFL justice.
Yeah, just to see the strategy behind.
Correct. When you see the strategy by looking at the whole field, that's when you go, yeah, I get it. And that's especially when I lived down here for a few years in the 90s, going to a few games at the G was just awesome. So really do appreciate the game when you see it live at the MCG. Oh,
well, wait. Sport definitely does make this country go round. But we're going to be talking about some big things that are happening at the moment. And obviously you need to be under a rock to not know what's going on in regards to some of these tariffs. So just for the layman, what's going on in the tariff world from the US? What are they looking to do? And also, just to flow on from that, there's pressure being particularly put on China.
Yeah.
So what are mainly the tariffs doing at the moment in discussions? And then what's the effect on China specifically?
Oh, look, it's a really good, great question. And the trouble is the answer to your question changes almost day by day. So let's sort of start at a fairly basic level. A tariff is fundamentally a tax on imports, okay? And the tariff is collected by importers and wholesalers. They pay, but it's basically passed on to consumers. So at the end of the day, if America imposes tariffs, American consumers and American businesses will pay the tariff. What are they trying to achieve? And again, it kind of depends on who you talk to. If you talk to or listen to President Trump, he'll say that world trade has been, or a number of countries around the world, China most notably, have basically been, in his words, ripping off America for decades, and he wants to do something about that. Now, whether that's true or not is an open question, but basically, in his eyes, he wants to make the system fairer for America's exporters. Put it this way, whether that's actually true or not is really an open question, to put it bluntly.
And it's more to stop the flows of money exiting the US. Now, like we said, if this is right or wrong is a different story. Last kind of tariff real increase in the US at these levels, from my studies, not my recollection, my studies, was the Great Depression.
Yeah, basically, economic historians talk about what's called the Smoot-Hawley tariff after the two congressmen that sponsored the legislation. And that basically jacked up tariffs to really, really high levels and arguably made what was going to be a fairly serious global recession a depression, or certainly made a massive contribution to it. So if Trump were to follow through on all the measures he's announced, you would basically see tariffs in the United States rise to, on some measures, at least that levels. On some other people's estimates, even higher than those levels. There's a few other angles here. He wants to raise money.
Yeah.
He basically says, I want to raise money and use that money to, depending on the day, reduce the budget deficit or to fund tax cuts or both. But at the same time, he says, I want to use the tariffs as a negotiating tool so that I can get a better deal for American businesses. Well, if it's a negotiating tool, it means you're probably not going to raise enough money out of it because if you're not prepared to cut the tariffs, then what are you negotiating with?
Yeah.
So it's not altogether clear whether the administration actually knows the full implications of what they're doing. There's certainly a lot of talk about negotiations to try and reduce the tariffs. They're talking about negotiating with, I think, somewhere between 75 and 90 countries to try and get a better deal for American business. But the trouble is they want to do that very, very quickly with a large number of countries. Historically, it takes at least a year, anywhere up to 18 months or 2 years to negotiate with one country. This is a really, really hard thing to do. And before you get there, there's still a lot of potential for a lot of volatility, a lot of uncertainty in the economy and in the markets.
I don't see how this benefits the US.
It's interesting. It certainly will benefit perhaps some people in the US to the extent that if there are American businesses that are going to be able to replace what is currently imported, then in theory those businesses should benefit. But it's not altogether clear that there are many of those businesses left. Is America really going to start to make better and cheaper T-shirts than the Chinese? And the answer is no. Even in more high-tech stuff, like your mobile phones and these sort of things, their suppliers in Asia and in China and in Taiwan, these countries are just really better at it. They can, and the kind of infrastructure they built up to supply not just the American market, but globally with a lot of these sort of very high-tech electronic stuff and technology stuff, trying to replace that in the American economy is, at least in the short term, going to be pretty much near impossible. So what it means is that a whole range of businesses that will need to buy stuff from overseas are going to face higher costs, and those higher costs are ultimately going to be passed on to consumers. This does cause a hell of a lot of disruption and a lot of cost and a great increase in the cost of doing business for Americans.
Yeah, and when I made that comment, it was more probably looking at it from more of like a general economy perspective. Like I don't see America as an economy. I see probably individual, like you said, sectors or businesses doing quite well. I just don't see that. And then obviously that brings on to other countries around the world, like Australia. You know, if they cough, we sneeze, so on and so forth. And so, like from Australia's perspective, in the kind of tariff board that he's put up, yes, we're down the bottom, but like, it's got to be concerning for us too.
Well, it is. Now, there's a couple of things I'd say. Firstly, we are relatively well placed, and always be scared when an economist says something looks relatively good, because there's clearly a sting in the tail, and here it comes. Look, our direct exports to the United States is relatively small. You know, we just don't export a lot of stuff to the United States these days. Our biggest trading partner is China, and more broadly, the rest of Asia. So the direct impact on Australia is relatively small. If, however, what Trump is doing severely impacts the Chinese economy, that's a much bigger deal for us, because that would affect not just the rest of Asia, but also it would affect us. Now, in the short term, that could be really, really bad for our economy. But even there's a potential offsetting factor. And there's two. One is the Australian dollar will almost certainly fall, which means our exporters will get a bit of a boost from that. But secondly, if the Chinese economy takes a hit, you can bet your bottom dollar that the Chinese authorities are going to respond with some very aggressive policy stimulus measures. They're going to spend some money to try and boost activity. And historically, whenever they do that, that actually helps us.
Okay.
So putting it all, long story short is, if this ends up being bad for the world, it's still not going to be great for us, but we are relatively well placed.
Yeah. Yeah. And I think what's the most interesting factor is I think there's a sense of like, who do we align with?
And that's a question the whole world, I think, is asking, especially now. You know, if there's some people in the US administration that have basically said, well, look, you know, how about we all just get together and take on China because China is the main villain here, if you like, in a trade sense. Well, after this episode, how much damage has been done to the US brand, if you like? How much damage has been done to the US's status as a trading partner, indeed as a partner in a whole range of issues, whether it be trade or geopolitics or the economy more broadly? That's an open question we don't have a good answer to. So the damage to US credibility could end up being a lot more damaging longer term and certainly a lot more long lasting because, if I were any foreign minister in Asia and the Pacific, I'd be spending a lot of time with my neighbours. I'd be spending a lot of time talking to all our neighbours in the Pacific and all our neighbours in Asia because I think that in unity there is strength. Now, exactly how the US and China play this out over the coming months, we have no idea because US policy seems to change by the day. There's a few things I'd say, though. There is an optimistic slant on this. Firstly, Donald Trump has shown a willingness to change his mind at the drop of a hat. If he senses that there is enough economic pain out there and financial market pain before that, that he hears enough whispers that the Republicans could get trounced in the midterms, he could just as easily change course very, very quickly, which means we could end up getting back to a more minimal level of tariffs, maybe higher than we had at the end of the last year. But Trump could just as easily change his mind and go back to something that's a bit more palatable for the markets. That's one angle. The other angle is that even if this does carry on, one of the things we've learned from economic history is that businesses tend to be adaptable and flexible. That business strategy adapts to the new reality. So they change where they source raw materials from. They change their cost structures. They change their business models to get used to the new reality, which means, and this is important for investors as well, it means that at some point, life, the economy and business and the markets move on. So in other words, I often say this when I'm presenting to our members, is that, look, there is always a light at the end of the tunnel, and it's not a train, it's the end of the tunnel.
Yeah.
And I think this current episode we're going through in history is going to be no different.
I think so as well too. When you talk about equities, bond markets, all of that, they're going through a world of worry.
Absolutely,
and it's constantly like, even if we look at these trade tensions that we're seeing right now, his first term also had trade tensions.
Oh, totally, but it was more narrowly focused. It was firstly trying to renegotiate the NAFTA agreement with Canada and Mexico, and it was renegotiated with with relatively small changes, to be frank with you. But certainly the tariffs he put on China, which were not taken off by the Biden administration. It's worth bearing in mind that when it comes to taking on China, when it comes to the view that China has behaved badly in world trade, that is a view that is shared across the aisle in US politics.
Yeah.
But one of the things I think the Trump administration learned from the first time was that China and other countries managed to get around those tariffs by rerouting exports through places like Vietnam or Mexico. Chinese businesses managed to just set up investments in places like Vietnam. Vietnam was a big winner out of Trump 1.0. You saw massive foreign direct investment flows, very, very strong economic performance as a result. But now Trump has decided to get it so that nobody can get around this. He'll just hit tariffs on everybody. The trouble is that in doing so, as I said, the damage he's done to the US brand and damage he's done to the reliability of the US as a trading partner and a partner in the world political sphere could end up being really significant over time.
It's really interesting, and obviously, there's a lot of moving parts that happen here, and as Brian was saying, things can change quite rapidly, and we might be releasing this podcast, and then there's more changes that happen. So
absolutely, we better make sure we put a date on the disclaimer that gets attached to this.
I think so.
It could change very, very quickly.
Very, very quickly, and I think the other one, Brian, that I wanted to kind of go a little bit deeper is into the state of the Chinese economy, because before all of this happened, we had a lot of like the property sector in China really getting under a lot of pressure. There's a lot of things like the One China policy really coming into effect now from an age demographic perspective. So my question to you is around, how do we see the Chinese economy, because we have become so reliant on things like you spoke about before, exports into that country, how is it?
Look, it's fair to say that firstly, the best days for Chinese growth were the last 20 years, not the next 20 years.
Yeah.
And there's two aspects to that. One is demographics. So you have a workforce that is basically aging and shrinking. You've got productivity growth, which has certainly started to plateau a bit. So you're not getting the same catch up in living standards and development and levels of development that you had when China was just starting out on its development path. So you're seeing a slowdown through slower productivity growth and that demographic story. And you're exactly right. A lot of the capital that has been used in China, and certainly you've seen a very significant build-up in private sector debt in China, and increasingly that debt has been used less and less productively. It has certainly funded a hugely oversupplied housing market, and it certainly has put downward pressure on house prices. Chinese households do kind of depend heavily on property for their wealth. And it certainly has made Chinese consumers more cautious than they otherwise would be. Traditionally, when faced with this sort of a challenge, the Chinese authorities throw money at the problem because they do. Certainly, if you're a Communist Party dictatorship, you've got levers you can pull that democracies don't have. And so that's certainly been our sort of view of things, if you like. Now, if you throw a trade war with the United States into the mix, where China, as basically a supplier of exports to the world, is just severely harmed, certainly if the tariffs that have been imposed by Trump stick, it means a whole range of Chinese exports into the United States are just simply not going to be competitive, which means even though you've already seen China as a share of US imports has come down in the last 8 or 9 years or so, it'll fall a hell of a lot further. That is going to cause damage to the Chinese economy. But the Chinese Communist Party, Xi Jinping is not going to stand by and let that happen. Make no mistake, his prime view, if you like, is he wants to maintain the supremacy of the Communist Party in Chinese life. In order to do that, he needs economic and social stability, and he needs to continue delivering some kind of prosperity for the Chinese people and improved economic conditions. So that means his response to those aims is to become more authoritarian on one hand, but also he is prepared to do significant policy stimulus to rescue the Chinese economy on the other. And I think that's what you'll continue to see.
And so bringing this back home again, Australia, I travel a fair bit and I'm very blessed to do so. And I see Australia as a premium product in a lot of areas. Yeah, if it be service, if it be our quality produce, if it be our wine. And I get a sense from China that, you know...
I just got a good idea of what your consumption basket looks like, by the way, but that's fine. I hear you, brother. It's fine.
You get me. But what I'm saying is that with what you're saying is that Australia is still going to be an exporter in that case, because when you chew those things down, that kind of sense of prosperity in the country gets removed as well too, because that was something that they weren't accustomed to 50 years ago.
Yeah, it's an interesting point. And certainly we have done very, very well as an economy by putting a large number of eggs into a basket labelled China. Okay. Now, that's been great for us, but make no mistake, at some point in China's development, are they likely to turn around and say, well, thanks very much for the iron ore, but we pretty much rolled out all the infrastructure and housing that we're going to need. So over time, you'll see that demand for iron ore start to potentially wane a bit. I'm not saying it's going to happen tomorrow or next year or next month or whatever, but at some point that will happen. Now, are there other countries out there that are sufficiently large with sufficient appetite for raw materials to take the place of China in terms of demand for Australian resources, most notably iron ore? The answer is possibly no. Even India, which for argument's sake is maybe 20 years behind China in the development cycle, yes, they'll also need some iron ore, but they also have a chunk of their own iron ore. So we need, I do think that there's a strong case for looking to diversify our export base. And certainly you've seen this in the resources sector, obviously with a lot of the discussion on rare earths, for example, where Australia is potentially a very meaningful supplier of rare earths to the world. That is also a potential bargaining chip with President Trump when it comes to negotiating some sort of agreement to bring our tariff rate down potentially. If it works, who knows? I have no idea. But certainly, what does the future for Australia's economy look like when, if we're forced to become less dependent on iron ore? we do have more strings to our bow. We still have a very strong education industry. We still have very strong tourism. We still have, a bunch of other raw materials that we can export. You mentioned our food and produce, which is, as good as anything in the world, really. But certainly that growth engine from resources is probably going to start to taper off at some point.
Yeah, it's very interesting, and obviously there's once again a lot of moving parts in regards to this stuff. But it's very interesting to see for the person in the normal household how much stuff is just affecting your money and your investments at any given time. And then these things do move. Does it have a vital impact on you that day? Maybe not. But this is why we're keeping a close eye on everything that happens, because it does impact the investments, which I want to get a little bit further into in a moment. But before I do, we've obviously gone into this kind of tariff tension. The word inflation has kind of been put aside. Tariffs are an inflationary kind of thing. But what I want to go in is around what's happening with inflation in Australia, because it was the buzzword for about 2 years. Where are we at now, and what's the expectation maybe over the next 12 months?
Look, I think what you'll see is, and this again is where Australia is perhaps relatively well placed. I've used that phrase again. I can't believe I got away with it again. But basically, tariffs are inflationary or potentially inflationary for the country that imposes them, right? So American consumers and businesses will pay more because of those tariffs, okay? However, without getting too textbooky here, if you just impose tariffs on any given day, that's a one-off increase in prices, which raises your inflation rate temporarily. But as long as prices don't increase in an ongoing sense, that the inflation rate will fall off again. Okay, that's still likely, but the problem the US is facing is that there may be a series of tariff increases, and also the other problem is what's called inflation expectations. And again, without getting too technical, but if people start to think that rightly or wrongly, tariffs are going to add to the inflation rate over the longer term.
My fees are going up because I'm expecting my costs to go up.
That's it. Well, it's basically saying, yeah, exactly. It's like, well, I'm going to raise my fees. I'm going to raise my prices. I'm going to demand higher wage increases because instead of expecting inflation to return to something like 2.5, I think it's going to be 3.5, 4, which means as a wage increase, that's my starting point. That means that higher inflation becomes almost like a self-fulfilling prophecy. That's what we saw in the 1970s and 80s. And it takes a lot of economic pain to get that out of people's minds again, okay? That has certainly been coming out in the Federal Reserve's comments in the US. Now, here in Australia, you have seen inflation come down. It's still, from the Reserve Bank's point of view, the various measures of inflation that they pay more attention to are still on the high side, but they're vaguely heading in the right direction. And that certainly allowed Michelle Bullock and her board to cut interest rates in February. We suspect there is probably another rate cut or two this year. We do think there'll be enough progress on inflation to allow them to do that. The other thing, though, is that for Australia, if we don't impose tariffs of our own, and I think it's highly likely that we won't, because all you do is shoot yourself in the foot. It's one thing for the Americans to shoot themselves in the foot, doesn't mean you should follow them in doing that, okay? You might feel better initially, but your foot will hurt. And so I think what you're likely to see is that as countries redirect a lot of output that used to be sold to the United States, it may mean that we actually get cheap products that are redirected towards us. And in a lot of cases, these are products for which there is no domestic manufacturer. Particularly in things, some of the sort of textiles and clothing and footwear, where the industry in Australia is a shadow of what it used to be, and we don't have a car industry to speak of anymore. So it means Australians could actually face cheaper prices for a whole range of things, which means from the Reserve Bank's point of view, the trade war is actually helping to drive inflation down further, potentially.
Which is interesting because they were talking, I think it was NAB was talking about in the next 12 months, 3 rate cuts. Yeah. And some of the banks talking about 2. And so, it does look like it's heading in that direction.
I mean, it's very rare for the RBA to do one, right? I mean, the joke I often use in presentations is, look, interest rate cuts, this is a Queenslander's joke really, but interest rate cuts are like cockroaches. There's never one, there's a family of them.
Yeah,
right?
I get it.
And but this time round, they were so reluctant in February. The commentary that they released around the rate cut, it was almost like they said, yeah, we're cutting rates, but here's a bunch of reasons why. It was very line ball. And I still think that there will be at least one more and perhaps 2. But, certainly internally, we're continuing to have that debate about exactly how far rates here can fall, in addition to having the debate about what is the longer term impact on the economy, what does it mean for markets and earnings and inflation. we don't try and spend a lot of time forecasting the short term. We're much more interested in how the world is going to evolve over the next 5 years, 10 years, 15 years, because at the end of the day, we're running superannuation money.
Yeah, definitely. Just on inflation, before we get into the investments, just around fiscal policy and government. Obviously, we've had the federal budget, and we were talking offline of being pretty much a nothing budget. There wasn't much in there.
Not a lot in there, no.
And then we've got this federal election coming up, and kind of close your eyes and roughly they're the same. Yeah, but what I was trying to get at, is there anything that's like catching your eye, both on what they're announcing, and then the second part of that is around, I really felt that through this inflationary fight, there was no real fiscal policy that really helped the RBA to tackle it. Was that a shared view from yourself?
It's certainly the case that certainly the heavy lifting in terms of bringing inflation down was very much borne by monetary policy. And that is more often than not the case. If you look at the history of these things, fiscal policy, politicians don't like delivering bad news. That's why you have independent central banks who make these really tough calls. To the extent that there was cost of living relief provided in the last couple of budgets, that cost of living relief was relatively modest. It was also delivered in such a way that it actually brought down inflation in a measured sense, even though it was just a bit of a one-off. I personally think that if you give politicians a bucket load of money through extra revenue, courtesy of the labour market or the economy or commodity prices, if you can convince them to not spend all of it, that's probably the best thing you can hope for.
And that was my other point around government spending. Like what I was also looking for is some action around maybe cutting, like we're in it with you. It felt like it was very much like you're spending too much, which is the general public. Whereas I would have liked to see the messaging at least of like, we're in it with you.
Yeah, it's an interesting one because don't forget that if you say we're in it with you, we're cutting our own spending, who are they spending the money on? It's households and businesses in Australia. So we're basically saying we're in it with you. We're going to cut spending, which is actually going to impose more pain on you. So it's not a great messaging at all, really.
It's not great messaging.
It's not great messaging. But I think what you can do, if I look at the state of the Australian budget, okay, and you compare the Australian budget and our level of debt to a range of comparable countries internationally, if fiscal policy is a problem anywhere, it's probably not here. I'm not saying we couldn't maybe, ideally go a little harder to deliver a surplus over time. Maybe we should, but is it absolutely critical at this point to have a surplus? I think the answer is no, to be honest with you, because frankly, one of the things which is clear to me is that, and especially you especially saw this during COVID, rightly or wrongly, the Australian people expect their government to step up in a crisis. There are certain things we want governments to provide. Now, if we want governments to provide these things, we need to have a more meaningful conversation about how they are paid for over time, which means we don't just have to run a ruler over what we're spending money on. I absolutely think that's an ongoing priority, if you like. But for too many years here in Australia, we've had this conversation about tax where whenever someone mentions the word tax reform, the first thing that comes into people's heads is, oh, good, how much am I going to get back? How much less tax am I going to pay? But the reality is if you want governments to actually do stuff for you, how are you going to pay for it? How are we going to pay for these AUKUS submarines if we want to proceed with that? How are we going to fund the health system? We have ongoing needs in the infrastructure space. How are we going to fund that? These are things that we need to have a more serious conversation about.
Yeah, and I think my commentary around it, and I think this is a view that's shared by people in my circle anyway, is more around just like efficiency of money. Maybe the messaging wasn't maybe we're in with you is around you're accountable to your household budget and you need to be more efficient with it. Therefore, I think we need to be more efficient with it. And we can see that this has been a groundswell that's happened in the US as well too. Like this Department of Government Efficiency, which kind of Elon Musk coming regarding if it's good or not good, we're not going to have that topic around. There's a sense that the government was spending, especially when you talk about like Victoria. I think we've got like a few $1 billion tunnel that's not even finished and they just found a sinkhole, funnily enough. So like it's local government, federal government, governments have been inefficient with their money. And I feel that that's where this groundswell has come. what does that have on our economy? What I'm more getting to is the inflationary discussion around if we're spending, we've got to be mindful that government spending does increase inflation.
It can do under certain circumstances. And if you're talking about spending that takes place over many, many years, and I think if you look at this, what the budget has done here in Australia, has it been thoroughly helpful to the Reserve Bank? Not really. Has it really stuffed up the Reserve Banks? No, it hasn't.
No.
So in the broader scheme, it hasn't actually done a lot of damage.
Yeah.
And even in the United States, there is this perception about the federal government which isn't really backed up by the data. The US federal civil service, the public service, is about the same size as today as it was a few decades ago, even though the population has gone up through the roof. So this idea that, and even here in Australia, after years and years of state and federal governments imposing so-called efficiency dividends and things like that to try and fill a budget black hole or fill a hole here and there in a budget. We got to. Do you remember when we tried to do a census online and that didn't? And how did that work out?
Not good.
No. If you starve the federal government of resources they need to fulfil basic functions and outsource every second thing, don't be surprised if, when a crisis really hits, they don't have the resources to do what you need them to do.
And you want a healthy government.
You do, but also, this is what I think. Paul Krugman, who's a US economist, Nobel Prize winner. The exact phrase eludes me, but you'll get the gist. The government is basically like a heavily armed insurance company.
Yeah.
Right. Their job is to be there as a backstop when things go bad. And that means they're basically providing insurance to people, whether it's in the health sector, unemployment insurance. They're a backstop during national crises. They're a backstop during pandemics. And they happen to have a military and paramilitary wing, if you like. Okay, not many insurance companies have that. But that is what government fundamentally is. And if that's what you need, and if that's what you want the government to do, you need to fund it.
Yeah.
Now, absolutely needs to be funded efficiently, but it needs to be funded.
Yeah, definitely.
It's a conversation that I think the world needs to have.
And we were talking offline, and I was saying that I've just got back from overseas, and I feel blessed every single time I come back around Australia, and a big portion of that is around how we run this country and how we're operated. So, for people that sometimes can get a little bit like, oh, we're in a bad place or we're not being run well. I think it's one of those ones that there's a sense of like, we are so blessed to be where we are and the structure we've got.
The phrase "the lucky country" has never been more relevant in my view. It was a phrase invented decades ago, but to me it still applies. I think I said to you offline that I was overseas last year and for work, and I flew back into Sydney Airport, and I just felt this sense of relief to be home, given the state of the world beyond us. Yes, we have problems here. We still have, we have a housing affordability issue. We have a shortage of rental accommodation. We have underinvested in social and public housing for decades. We've seen new residential building approvals relative to the size of our population fall to pretty much as low as they ever fall to. It started to improve. We're starting to see a bit of a pickup in new building approvals. But if you really want to do something about housing and about house prices and housing affordability and availability of rents, you need major reform to the housing market. You need more supply. And you also need to perhaps encourage, especially people who rent. Right now, a third of the population rents. And in many cases, their security of tenure, especially if you've got a young family, is pretty limited. The idea that you might have to uproot your family and uproot kids from schools and childcare, etc., because at the end of your 6-month lease, the landlord's decided to do something different. Is there a scope to do something more substantial there in that industry to try and address this? I think there is.
Well, in Malta, I know where my family's from is there's 99-year leases.
Yeah, and look, I know in other parts of Europe, 5-year leases are very common. 5 year by 5 year with an option to renew. At least you have security of tenure. In the United States, it's very common for institutional investors to invest in multifamily residential, where the institutional owner is effectively the landlord, and they look after the interests of all the tenants in this particular block. They have longer term leases, they have security of tenure, and they look after, and their job is to maintain it and and protect the investment, if you like, by ensuring it stays a good quality asset that is well occupied and that the rents keep flowing in. So I think there's some scope to maybe, think about how we do housing better in Australia. I think there's some scope to have that discussion.
And is this where the federal election has got that play in regards to a lot around the housing policies that you've seen?
Yeah, and I just don't think much of it's terribly helpful. For too many years now, we haven't done enough on the supply side, and all the measures have been about how do we give people more money so that they can bid up prices more over time. And that's not really helpful. I often say that if you look at there's a whole bunch of political theory about the median voter. And if you're a politician that wants to survive, then you need to be very careful that your policy prescriptions don't deviate too far from the median voter. And right now, the sense I get is that the median voter is not a renter. The median voter is either owns their house or is paying it off. And does the median voter want to see house prices either stabilise or fall? Maybe they don't. So that may be a politically challenging message. Even you say, well, I want housing to become more affordable, but not before I've made a lot of money on my housing investments. I just think that there needs to be a bit of more serious discussion about this. Now, over time, if the median voter becomes a renter, then that changes the political dynamic. The other thing which I think has become a problem here is that when you look at the data on first home approval, so in other words, is it the case that nobody can borrow money for a first home? No, it isn't actually. You look at the percentage of total home loan approvals that are for first home buyers, it's not massively higher or lower than a longer run of history. It's about in the right ballpark. The bigger issue is those people are increasingly likely to have had the right parents or the right grandparents. Is that the kind of society we want, where your ability to buy a home depends on the genetic lottery of life, who you were lucky enough to have as parents or grandparents? The bank of nan and pop, the bank of mum and dad. And I fear that that's the country we're becoming.
And it's the separation that we're seeing between the wealthy and the poor. So it's spoken obviously about a lot. And now I want to kind of just realign just to investments because, the economy has a massive, huge play. We've got federal elections, we've got governments, but reality is that households and our clients and investors, they're worried about their superannuation.
Yeah,
they're worried about their investments. So first and foremost, just a quick one while I've got you. Okay, I'm not sure if you know a lot about this because it may not be in your wheelhouse, but Australian Retirement Trust, there was some stuff about cyber that happened recently. Now, we have some clients with ART, and we were very happy to hear that ART was not affected by any breach for our clients specifically. But can you just elaborate a little bit more before we get into the actual investments?
Oh, sure. Look, the short answer is the defence has worked. So somebody tried it on and they failed. The defence is held. So it was a suspicious transaction. It was flagged. It didn't get into the system. It basically got stopped at the door, and that's great. That's a good outcome, and there wasn't a penny of members' money lost. So that's great. That does not mean that we or indeed any super fund can be complacent because these people are only going to get cleverer. They're only going to get smarter. They're going to keep on trying, which means that we need to ensure that our defences stay up to the task. So, yes, good result for ART members. Very relieved and very pleased about that. But complacency is death in this business.
Exactly. And I think the biggest thing is that I've heard from a lot of people in the cyber industry is you can still let them through the front door. And so what that means from a household perspective is around making sure your passwords are strong, making sure you've got two-factor multiplication, and making sure that you're educated in regards to these things that can happen. Because in most cases, it's simply letting someone through the door. So you can have all the measures in your house. You can have alarms and cameras and stuff. And if you just open someone and let them through the door, well, all of that means nothing. So make sure you're completely aware.
Correct.
Now, going on to the investment sides of things, obviously volatility is back. We've talked about all of these tariffs and everything, what's going on. What's going on in the equity market? Let's start there. What's going on in the share market?
Yeah, look, I think at the end of the day, tariffs and trade wars are bad for growth and they're bad for inflation. Let's put it simply, okay? Certainly bad for growth and potentially very bad for inflation. And that is unsettling markets. There's another layer as well. You look at what's happening in the United States, and while certainly the fact that tariffs have been being imposed, and this certainly is damaging to the US economy, that's bad for equities, but it also has helped drive up interest rates, bond rates, which means fixed income investors. that hold government bonds issued by a range of countries, but most notably the US in this case, have seen bond prices fall and the yield on offer rise. And the reason that has happened is that if you're going to expect, if you see a risk that inflation is going to be higher than you previously thought, well, in order to hold these US Treasury bonds, I want a bit of extra compensation in the form of a higher yield on offer. So you've seen some disappointing performance numbers out of the US equity market, but also out of bonds. How long that persists for, we do not know. One thing we do know is that when you look at the history of these things, crises come to an end, recessions come to an end, downturns come to an end, sometimes sooner, sometimes later. Crises, whether they be trade-driven, geopolitics-driven, or whatever, they are part and parcel of being a long-term investor. As I say often, there's always a light at the end of the tunnel, and it's not a train. I don't think this will be any different. At the end of the day, at some point, life and the economy and business will move on. But certainly what's been happening in equity markets reflects the fear that a trade war is bad for the economy and therefore bad for corporate profits and therefore bad for share prices.
And let's get this straight that the market is trying to anticipate what's going to come.
Well, the market is basically more forward-looking than any analyst or any economist or any financial advisor or journalist or whatever. And it doesn't mean they always get it right, but they are always trying to anticipate what is going to happen, absolutely. And certainly you would expect to see if there is going to be a recession, and we don't know with 100% certainty at this point, share markets tend to move in advance of that. They also tend to recover before the economy does, by and large. And again, I think that's probably how it would play out in this case.
Definitely. So when we see the defensive side of the portfolios in regards to obviously cash accounts, we're looking at fixed interest. What's your outlook there? Like we've spoken around like equities being forward looking, anticipating for things to go bad. What about the defensive side of things?
Yeah, I think certainly you've seen the fact that you have seen bond yields rise, bond prices fall. So in the short term, you've seen negative performance from those markets. But what it also means is that the future returns from those securities is now better.
Yeah.
Because I can get a better yield, future yield by buying them today than I could buying them a few weeks or months ago. Okay. And in particular, if I think about where interest rates got to and where bond yields got to during COVID and in the aftermath of COVID, where they fell to historically very, very low levels. Back then, if I was a defensive investor relying on government bonds or high-grade corporate bonds to provide me an income and to protect my capital during volatile times, I wasn't really getting that because the yields were so pathetically low. In fact, to be very frank, if I could have, 5 years ago, if I'd have said to you, look, I think if we buy a portfolio of government bonds, we will get a positive return after inflation in the next 5 or 10 years, I think I would have been disingenuous. I don't think that would have happened because the yields are too low for that to happen. Now, because the yields are better, I can buy a portfolio of these bonds and I've got a much, much better shot at getting a positive return after inflation and after costs and still getting a reasonable income paid into my account. So for defensive investors, the future returns now look at least reasonable, whereas previously they
look more attractive. We
look more attractive,
having this conversation and talking about defensive assets just in regards to cash with the likelihood of interest rates coming down a little bit. You know, these defensive assets, even though they're going to impact price and whatnot, they still look more attractive now than where they were maybe 12 months ago.
Right. Yes, that's the thing because interest rates have risen. And I think over time, our basic thinking is that think about the Australian cash rate, right, which is currently, about 4.1. Now, we think that over the medium to longer term, on average, what should that cash rate average?
Yeah.
It should probably have a 3 in front of it over the next, say, 3, 5, 10 years. So what it means for defensive investors, when you're thinking about, well, what sort of return should I be able to expect from the different parts of my portfolio? Means over time, if I get 3 to 3 and a bit out of cash, that'll probably give me a return that's above inflation, and that's a much better result than I would have got some years ago now. I'll probably get a little bit more of a return with the government bonds and corporate bonds I have in the portfolio. And over the longer term, if I'm prepared to take equity risk, if I'm prepared to accept the volatility that comes with being an equity investor. Will I get compensated for that volatility through a higher return? Absolutely. Will I always be compensated? No, clearly not. And the last few weeks has been a case in point. Often get asked, by members and by clients generally, well, look at the mess the world is in. Why would I put up with the risk that equities are providing me at the moment? Why would I put up with all this volatility? And my short answer is this, is that the reward for putting up with this crap is a better long-term outcome.
Yeah.
At the end of the day, if you could sum up the markets and sum up a free market economy, if you like, in one sentence, it's you get rewarded for risk over time.
Yeah. And a very much a thing when we build portfolios is around making sure the money is in the right timeframes. And this is very, very good and very, very fundamental. You know, if you've got your long-term assets sitting in cash and you don't need that money for 10 years, well, the inflation's likely going to eat away at your return. Yeah. But if you have the long-term assets, say in equities or in property, that's a long-term asset class, it's going to produce in the long term. But in the short term, you're going to have that short-term pain. And if you look at all of the data, you know, you invest in shares in an outcome in say 12 months, you want your return. The probability of loss is as nearly close to the probability of gain. And that is very important. So timeframes are very important to reduce risk, and the risk is what dictates the return. And so my last point on this, we've had a new generation come in with alternative assets.
Yes.
Okay, they're looking at traditional assets, fixed income bonds, equities, cash. They're looking outside of this and they're saying, nah, you know what? For me, it's silver, gold, or crypto. One of the three. And we have prospective clients that have come to us, they've sold out, they've withdrew all of their superannuation, small balances, we're talking combined maybe 150, 200 combined, liquidated it all, and I look at the accounts and there's silver, gold, crypto. My question to you, Brian, has your view changed in, say, the last 10 years of what a good, solid portfolio looks like, as in regards to the asset class, and maybe not the percentages of where they sit, but the actual buckets? And what's your views of things like gold and stuff like that, where people are looking at these investments and going, they're not for me?
Look, I would say a few things. Firstly, let's talk about gold and silver, okay? The precious metals more broadly, these are... they certainly have history under certain scenarios where the world becomes really problematic, or there's a crisis scenario. Under some of those scenarios, having gold or silver or platinum perhaps, but gold is the traditional one,
and we're
in
talking
your portfolio,
about
might make some sense. However, over the longer term, here's the problem. You're still talking about an asset that pays you no interest, no income. It is still quite speculative. It can go up and yes, has gold done very well over a run of years now? Yes. But frankly, in investing money, I think investing money is kind of like driving a car. The rearview mirror is kind of interesting, but the windscreen is much more important. And getting into an asset after a bunch of people have already made money out of it, that rings alarm bells for me.
It increases the risk.
It potentially does. And the other thing I would say is fundamentally, I want assets that where does wealth get generated? Wealth fundamentally gets generated in the economy, and it gets generated fundamentally by businesses. Businesses that employ people, that sell products and sell goods and services. They make a profit. They pay a dividend. What they don't pay in dividends, they reinvest back into the business. And when they do that, the value of the business grows over time. That is how wealth gets built in the economy. Now, it doesn't mean that every business is going to do that. Some businesses will do extremely well. Some businesses will go belly up. But on average, the typical business that makes up the economy and the typical business that is listed on the stock market or invested in by private equity investors, that business over time, on average, is going to grow the wealth for its investors. I'd much rather put the lion's share of my wealth there, real incomes, real growth potential. A lot of what we've talked about when you think about gold and silver, to me, it's too much of a speculative element. Okay. The other thing, you did mention crypto. So the fact that you've mentioned the C word, I'm sorry, you've given me carte blanche. Right. Again, crypto currencies generally, they are highly, highly speculative assets, often traded on exchanges that are, shall we say, somewhat opaque. The real world uses for some of these currencies has been to finance the illegal arms trade. If you get hacked, quite often the hacker will ask for ransom to be paid in crypto. The illegal drugs trade. Is this really the company I want to keep when I'm investing our members' superannuation money? I'm not sure it is. Is there some potential scope, if I look at some of the underlying technology behind some of these currencies, is that potentially interesting? Is there real world applications for some of these technologies? Potentially, yes. And certainly some heaps smarter people than me in the venture capital and private equity space have an ongoing interest in this space. But fundamentally, these are still highly, highly, highly speculative assets. I would much rather invest in things that actually provide me an income. There's a difference between, am I an investor or am I a punter? Now, we're in Melbourne. Now, if you want to have a punt, go to Flemington. You can have a nice afternoon out, have a few beers, catch up with some mates and have a laugh. If you want to invest, you need to do something else. And to me, too much of the crypto story is frankly just too speculative. Would I want the lion's share of my retirement prospects dictated by some crypto nerd sitting in his basement mining Bitcoin? I don't think I really want that.
Brian, you've hit exactly the note that I've been taking on all of this. I don't have a dime in any three of them. And people can say to me, John, why don't you have them? Well, my investment philosophy is based off similar to like Warren Buffett's, which is essentially I want to buy in something that produces an income.
That's it.
Okay. And if it doesn't produce an income, it's not an asset to me. When I went to university and they said to me, John, you've based the value of an asset based on its future income.
Yeah, you discount future cash flows back to present value. Yep.
So if I have no income, what's my asset value?
Correct. An asset like that is, now to be fair, any asset is worth what someone's is prepared to pay for it on the day. But at least if you show me a share or a bond or a property, I can have a stab at valuing it for you. I can have a stab at saying, well, look, this is what the property rents for. This is what comparable sales are going for. This is what the company's dividends look like. This is their growth prospects. And given all of that, I'd be prepared to pay X. Now, X may not be right, but I can actually come up with a view on what an asset is actually worth and what I should be prepared to pay for it. But with gold and with Bitcoin and even silver, it's like, well, how do I decide what is a fair price on any given day? And then it does get complicated.
Neil deGrasse Tyson said something recently. He said that as time has gone on with humanity, we have prospered more and more and more. However, when they've surveyed people on the way that they view their life, it's got worse and worse each year as time goes by. And I think because of the sensitivity of social media, the fear mongering that's put to get your attention has caused people to go to, like you said, in the world of we need gold, we need silver because the world's going to end. When you were talking about those events where gold and silver have become really valuable, let's be honest about this. We're talking like World War II. Yeah, we're places where money's not even an issue. Like my job is not even worth because we're just worried about putting food on the table.
And also a lot of the historical experience was when the world basically had a gold standard and the gold price was fixed. For much of the last X number of years leading up to, say, the 1970s, gold traded at $35 an ounce. That was the price. We don't have a good handle on how gold may behave in a serious, like an episode like World War I or World War II. We think it would be a safe haven, but can we guarantee that? Not really. To me, again, it's funny. The sad thing is I'm now about to turn 58. I'll turn 58 in June. I've become a much more boring investor than I ever thought I would be. But I'm okay with that.
If it makes you feel any more happier, I'm boring as batshit, as they say too. So we might end it there. But Brian, thank you very much for jumping on.
Great to be here.
Really, really great chat. And hopefully you guys are enjoying these chats as well too. So make sure you like and subscribe on all of our channels and share them to some friends and family. Until next time, see you there. Thanks, Brian, again.
Good on
Thanks,
you,
everyone.
Cheers. Thanks, everybody.
Thanks.